Good morning. There's the opening bell, and welcome to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend and fellow coach, Connie Hill, 20-plus year veteran in the financial market. She's been doing this for a while as well. I'm glad to have her here, helping to facilitate the conversation. By the way, if you're there in the chat today and you're joining us live, welcome to all of you. If you're joining us in the recorded version, welcome to you as well. We're glad to have you with us. Be a part of the conversation by chatting in a question. Connie will help out. I'll try to answer those as best I can. If you're in the recorded version, leave a comment in the comment section. I respond to all of those, as does each of the other coaches that teaches webcasts. We respond to your comments there in the comment section. Interesting few days, interesting week in the futures market, interesting morning in the futures market. A couple of things I want to address today. We've got a couple of different trade examples that I want to look at. Oil's moving, the volatility index is moving, some of the precious metals are moving a little bit. But I also wanted to address along the way the question that comes up a couple of times, and it's come up in the feedback survey responses that you've given us, and that is, what's the relationship between individual stock movement and, say, for instance, an index futures contract like the /ES? And so we'll explore that here just for a bit this morning, but I got a couple of trade examples that I want to look at first, and then we'll get into that explanation discussion. So a couple of quick reminders and housekeeping items here. Remember that everything we talk about simply for illustrative and educational purposes only. Remember that everything we talk about is just that illustrative example. It is not a recommendation of any particular security or strategy or advice or anything else. Remember that futures and futures options trading involves substantial risk, not suitable for all investors. Make sure that you understand and read the risk disclosure statement for futures and options prior to considering any futures transaction. Futures trading requires separate trading authorization, requires a initial margin and a maintenance margin to initiate and hold futures positions in your trading account. Now, when we talk about things like virtual currency derivatives, make sure you understand that those have special and unique and significant risks. They are representative of or virtual currencies, which is a digital representation of value that doesn't function as legal tender, at least not yet. Make sure that you read the NFA investor advisory and the CFTC customer advisory about those particular products. Now, we're going to be using the thinkorswim desktop software platform, specifically the paperMoney version of the platform. Not a guarantee of future success out there in the real world, but a great learning environment in which to practice. I just heard a trade ding go off here, so interesting to see what happens and what that is, if it's one of the trades that I put on here. But again, one of the things that pay attention to is that paperMoney does not do certain things that a live trading account will do, and it behaves a little bit differently, namely in the nature of order fills and the handling of short option contracts. So just be aware that there are some differences. We're going to use some technical analysis here today. It's theoretical in nature, as is any method of market analysis. Nothing is guaranteed. And as a matter of fact, Schwab doesn't recommend the use of technical analysis or any one method of market research as a sole means of investment research. Now, just really quick, I want to point this out, and I've talked about this before. The way that the futures market handles stop orders on futures contracts is different than how that's handled on an equity, for instance. Due to exchange rules, stop orders that generate a market order will be substituted or rejected, but primarily substituted with an exchange designated limit order that works within a particular protection range. There is the possibility that price could move, especially in a fast moving market, the price could move outside of that protection range, in which case the order would not get filled or may very well be rejected or may fill at a different price than is expected. So just be aware of that. All right, so let's jump into this discussion here really quickly, and let's pop over here to the thinkorswim desktop software platform. Yeah, K Brown, you're right. paperMoney doesn't need futures permission just simply because, if your account is permissioned for that, that's something that you can practice with in terms of paper money. Now, let's take a look at what's going on in the futures market at the moment, at least in terms of the equity futures, the ES futures at this point, kind of bouncing down from that 200 period moving average. We saw a break below that last week, rally up into that level, and perhaps a little bit of a penetration of that level today or yesterday, coming back down today. And that RSI still falling off just a little bit in terms of the ES, the S&P 500 futures. The NASDAQ futures doing something very similar in this particular case. This is creating a little bit of a candlestick pattern, which is kind of interesting, at least at the moment. This is a candlestick pattern that Pat Mullally and I used to refer to as bearish earmuffs. So you think about it, you get this small bearish candle, a big green candle, and then a small bearish candle on either side of that big green candle that kind of look like a pair of earmuffs, if you will. Bearish earmuffs in that the two oppositional small candles are red or downward movement. And generally that's an indication that you're seeing a lack of follow through on that green candle, and it can lead to some downward movement. It doesn't have to, but that is generally the thought in this particular case. What matters is what it does, not what it looks like and what it suggests that it's going to do. The reality is this doesn't guarantee anything, nor does any individual candle or candlestick pattern doesn't guarantee anything, because news always happens. Take a look at the Russell 2000. We see the same kind of thing. You see a bigger down candle followed by a bigger up candle, followed by a smaller red candle here in this particular case. And so as we start to see this movement here, maybe a little bit of downward trending in the RSI, that's a suggestion that we're maybe seeing some, maybe a little bit of profit taking from what happened yesterday in terms of the futures contract, in terms of the S&P 500 movement, in terms of the broad indexes, maybe a little bit of profit taking. Now, the other thing I want to take a look at really quickly is I want to come over here to our VIX grid, just so we can kind of get a sense of what's going on in the volatility market, which is in fact one of the trade examples that I want to look at here in just a second. But volatility up a little bit this morning at 27.08 currently. And we saw volatility bleed off again in opposition to what we saw yesterday. Typically that inverse relationship between SPX and VIX staying in place here at this particular case. When the VIX is up, often that's an indication that the SPX is down. And likewise, if the SPX is up, the VIX is generally down. And we see that kind of relationship going on in the last three candles here. It doesn't always work that way. But in this particular case, yeah, we're going to take a look at crude oil here, stay gold. Absolutely. So we're going to pop into that here in just a second. I wanted to get over to this just so that we can kind of get a sense of what's going on in the market. So now what I want to do is pop over to our, actually, you know what? I'm going to put it on this longer term grid. I'm going to come back to our futures grid, and I'm just going to use this longer term view, and I'm going to change one of these to /CL, to crude oil. And I want to kind of look at what's going on here. So we've seen this, strong rally, obviously, from the March timeframe beginning, this breakout above that 66 mark. We've been talking about this kind of on a regular basis. We've placed trades a couple of different places in this relationship. Now, on the daily chart, which is what we're looking at, RSI is trending down, although it's starting to tick up a little bit here. It's not breaking this diagonal trend line necessarily, so we're not getting a lot of upward momentum necessarily, but you're seeing the 50-period moving average turning higher. You're seeing the 200-period moving average turning higher here, and we're starting to see a bit of a bounce once again. Now, yesterday was a news-driven day, suggesting that changes were afoot in the geopolitical circus situation that's going on. And that drove crude oil prices down slightly, number one. Number two, now maybe the reality is sinking in that maybe there's still that potential that Straits of Hormuz is staying closed, that we're seeing some demand destruction. We're at that level of demand destruction when it comes to things like heating oil, diesel fuel, jet fuel, because those prices from a refinery standpoint have been going up. But that is playing into crude oil continuing to move to the upside here. So we're kind of seeing that little bit of it was a slight gap down into this rally, because we can see that open just very slightly lower. And then that rally higher, right? Okay, and again, I slip of the tongue. I'm not getting political about this, and I don't, as a matter of course. But yeah, I mean, geopolitical news is geopolitical news, and it creates volatility, and that's why we're seeing the volatility elevated. We're seeing crude oil moving and behaving in the way that it's moving. So I wanted to kind of bring that into the picture. Now, what I want to do is I want to shift over to our futures grid, and I'm going to pop over here to futures, and we're going to pop into /MCL, which is the micro crude oil contract. Now, micro meaning that this is a tenth of the large contract. The large contract is /CL. For those of you who have been with us before, we've gone through that discussion of the different contract specifications. For those of you that are brand new, and by all means, thank you for being here and welcome to all of you. I want to pop over here to the right-hand side of or the left-hand side of our grid so we can take a look at this. This is the crude oil contract. Remember, you see the similarities between what we were just looking at with /CL, the large contract, versus this contract, which is the micro. So this represents, in terms of notional value right here, a tenth the size of the large contract. Tick size is 0.01, which means that this is our significant digit. This one right here, 92.54. The last digit in that sequence is the significant digit. That's the one that's incrementing, and it's incrementing by 0.01. So it's going from 1 to 2 to 3 to 4 to, so on, right? It doesn't increment in fives or whatever. We'll see that difference in the case here. The tick value is 1. So every time that ticks, that's $1. Every time this point moves, that's $100. If I were to change this to /CL, you're going to see the tick size is the same, but the tick value is 10 times larger. It's $10 versus $1, which means that the point value, when this changes from 92 to 93, that's $1,000 of change. Okay. So in order to get to our notional value, we take the point value times the price. That gives us our notional value. So we go back to the /MCL, point value, $100 times the price of the contract gives us our notional value of $9,249. If we click the drop down and we go to the futures sub tab, we can see that the micro crude oil futures, there's our tick size, tick value, and our initial margin for initiating a position. Initial margin is the amount of capital that needs to be held to initiate that futures position. It's not really that we're buying or selling the futures position. It is that we will sometimes say buy or sell, but it is going long the futures position or short the futures position. We're initiating that by holding that margin, and then we're maintaining that position as it gets marked to market by holding that maintenance margin. So that's kind of the difference between, say, for instance, buying an equity versus initiating a position in a futures contract. If we were to go to /MCL, or excuse me, CL here, /CL, you can click on the drop down. Here's the futures contract, and there's the light sweet crude oil future, tick size, tick value, and initial margin is 10 times higher, right? $10,000 required to initiate a position as opposed to $1,000. Okay, so that gives us our differences here. So we're going to come back here. We're going to make this /MCL. And what I noticed, oh, by the way, first of all, what I'm noticing is that there is a feedback survey out there in the chat. Please, please, please fill out that feedback survey. Let us know what you feel about this particular webcast. That's how we make these better for you. It is gold for us, basically. Not gold futures contract, but it is gold for us as educators to be able to make these webcasts better for you. So take the time, if you wouldn't mind. Connie's going to pin that to the top of the chat so that you don't lose that. So now that we've looked at the longer term chart, we can kind of see what's going on. Still, RSI rising a little bit on the short term, but it's not breaking that diagonal trend line. So we still have some downward pressure. Nevertheless, we see a little bit of a bullish candle today. And if I go over to the right-hand side of this grid, and by the way, this grid is in the description page for this webcast, but I will share it with you as well. Remember, anytime we share anything, it is for illustrative and educational purposes only, and it is not guaranteed as to time or accuracy, okay? So there is that. Okay, so Wacky asked the question. So there's no mini like the S&P because crude micro is already a tenth. So there's the full contract, right? That's $1,000 per point times the price gives us that larger notional, and then there's the micro crude oil. So there's not what's referred to as a mini contract. If there were demand, there might be some intermediate between those, in terms of the size. So if you want to think about it in terms of barrel equivalents, Wacky, the large contract represents 1,000 barrels of crude oil. The micro contract then would represent 100 barrels of crude oil. All right. So what I was looking at here this morning as I was watching this, because I started watching this morning at about 4:30, because I'm crazy and get up early. About 4:30 this morning, this little bit of a bounce that we started to see up off of the right-hand side of this W pattern. And I'm just going to kind of draw this in here so that you can see what I was looking at was kind of this W type of pattern there, right? So I was looking for a break above here. And we got the break above that level, and so this is about the time that I got done with the network hit. By the way, just doing. I'll talk about that later. We'll talk about that in a bit. But watching for this little bit of a break here above this kind of neckline, if you will, of that double bottom or kind of W pattern. That W pattern leading us to this idea from a technical analysis basis that if there were a breakout of this range, that we might see a distance that may be equivalent to something like that. So what I did is I drew that line and I made that kind of the potential target here for this breakout. So there's the target, putting that target up around 94.5 or so. If this made that move to the upside. Yeah, for sure, Carol. It's just I've lived my life so long for so long getting up early, and especially when I'm traveling. If I'm on the East Coast, then early is a relative term. Yes. But looking for that breakout. So I put an entry here at 92.09, roughly, giving it a little bit of time and a little bit of movement to get out of that range, right? So not just looking for the specific breakout of that resistance level that I drew in here at the 92 level, but looking for a little bit extra, right? Just giving it a little bit of flexibility so that it didn't just bleed above there. And so I got kicked into the trade right here. It pulled back almost immediately. I had a stop loss in place here at 91.5 is where the stop is in this particular trade, looking for a move to this target, which is just simply the symmetrical distance. So here's the thing. It could be completely agnostic. 4:30 person is getting up early in the morning to watch the futures dig in for sure. But the idea here is this is really agnostic. The methodology here is agnostic to whatever the symbol is. I'm not looking at this necessarily because it is crude oil. I'm looking at this and was looking at this potentially because it was a pattern that was developing that oftentimes, but not guaranteed to, move in a symmetrical distance. So if you want to learn a little bit more about this, Rachel Deshelle, one of our great coaches, and in fact, our newest coach, teaches a great webcast, I think it may be on Tuesdays or Wednesdays, might be on Wednesdays, on trading price patterns, where she talks about a lot of these different price patterns, including these W patterns and elsewhere, and looking for that symmetrical movement. And looking for this to move out to that particular distance. So I created that order, entering on the breakout, target up here, closing the trade down if it goes to that level, or closing the trade down if it goes down here to this stop level. Now, what we could do in this particular case, and what I'm going to do is I'm going to grab this gear icon, and anytime you see gear icon on the thinkorswim platform, it's a place where you can change or adjust something on the platform or customize. So here's where my stop is. You can see where that stop order is, and it's linked to this order in an OCO relationship. So if one of those gets triggered, the other one is going to go away. And remember that stop orders, like this one right here, this is a limit order. So that's going to create an order that is going to be exposed to the market and will likely fill. This one, if it gets triggered, is going to trigger an exchange designated limit order that may get gapped around or may get moved around if it doesn't fill. So that's a possibility. That's just that difference in the way that stops are created. So what I'm going to do now that this is filled, this was my initial risk in the trade, was getting into the trade and then down to here. Now that this is filled and it's tested that entry point, which was a previous resistance level, in order to maybe protect a little bit of and reduce a little bit of risk. See, I knew it was on Wednesdays. In order to reduce potentially a little bit of possible risk in this trade, I'm going to move this stop up to where my entry was. So rather than leaving this risk all the way down here, leaving that stop level all the way down here as this continues to go higher, I'm going to adjust this stop now that I've tested and validated this, what was previous resistance, now as a level of support, because a candle came down, tested it, and rallied up off of it. So I'm going to move my stop just by clicking and dragging up to that level right here. And it's going to give me the opportunity to read through that order. 92.05, I'm okay with that. 92.05 is fine. And just cancel and replace that stop. And I'm going to send, and now it's canceled and replace that stop order. So we've reduced the risk a little bit in the trade from where it was when we initially entered the trade. And that's, potentially could be a good habit to get into, just simply from the standpoint of establishing a new level of if this, then that. If price breaks this level, then this is where I theoretically may get out of the trade. And I'm just adjusting to that upward movement to follow that trade to the upside. So that's kind of the relationship here and what we're looking for. So if we go back over here to the monitor tab and we take a look at what's going on in this MCL trade, we entered at 92.10. It's currently at 92.36. So we've got a little bit of a gain in the trade. We see what our initial margin amount was. A little bit of gain in the trade as it continues to move. Theoretically, that's going to increase if this goes in the direction that we want it to go. All right, so let's come back over here to the charts. And let's come back to our side-by-side, and I'm going to bring in /VX. This is the volatility index. Same kind of thing. I was looking for this move to the upside in the VIX. If oil was starting to pick up a little bit, that suggested that maybe there was downward movement in the futures. Saw the downward movement in the futures. That's bringing the VIX up a little bit. And we're going to take a look at the left-hand side first. So I'm going to maximize the left-hand side. There's the VIX, that VIX chart. But now we're taking a look at the VIX futures. Tick size is 0.05. So this is going to be our significant digit. And you're going to see that significant digit move typically in 0.05 increments. And it's starting to move in slightly different increments here, but the ticks are going to be in 0.05s. Every time that tick moves, that's going to be $50. that point value, when this moves 25.0, when that moves from 25 to 26, that's going to be $1,000. $1,000 times that gives us our notional value. And there is not a micro contract, to my knowledge, to this, to the VIX. But we can pop over here to the futures. We can see the VIX contract initial margin is a little bit higher here than what we were looking at on that micro crude oil contract. About $9,700 for that initial margin tying up to initiate a position in this particular contract. So let's go over to the right-hand side. And what I was looking for was that same kind of pattern, right? I saw that same pattern developing itself. So I saw this again about 4:30, saw that relationship going. It pulled back down, rallied back up, kind of tested near that area, and it's rallying up again. So looking at getting into the trade on that breakout, and I actually saw that already before I put the trade on. So I entered this not as a buy stop, and remember, a buy stop works the same way as a sell stop when it comes to that exchange designated limit order. So I got into this on a limit order as opposed to a buy stop, which was stop wait for something to trigger. Got into this on a limit order, and it's not come down and touched my stop yet. My target is up here right around the 26.25 level. It's pulling back a little bit. We could see a little bit of volatility as the market gets up and running. We're less than 30 minutes into the market, so still a little bit of volatility going on this morning. But once again, we validated this level, this entry level, as a level of support. Was a level of resistance. It's pulled back into that level and it's bounced. So what I may think about doing here in this particular case is taking that stop, just like we did with the crude oil trade, grabbing that and putting it right up here on that line and just clicking. And now we're going to replace that order at 24.90. Click on send. And now we've got that stop order adjusted and we just got stopped out. So that's what can happen. And you saw it happen in real time. And it wasn't, and I just want to say this, it was not that stop order became visible, because this is not a live trade, number one. This is a paper money trade. You just want to make sure that everybody understands that this is a paper money trade. But we moved that stop order up because the price had moved higher and is now coming back, bouncing off of that support, rallied up. We moved that stop order up a little bit simply because as that trade moves higher, that risk gap, that risk amount continued to increase. So I was trying to close that a little bit, and it in fact got stopped out. That doesn't invalidate the overall directional trade here. It just simply says that that stop was at a point at which there was a possibility of movement and it might get kicked out. So we got stopped out. You know what? That's okay. That's exactly what a stop order is designed to do, right? A stop order is designed to do that and kick us out of the trade. Could this go higher? Yes, it very easily could. So what I might think about doing now, because there's the possibility that volatility continues to move higher here, trend strength is still there. The ADX is still above 25, which suggests that this is a strong trend. But what we might do here in this particular case is come back up here to this resistance level that's been established, right? Because that's now what's happened. We've seen price go up to this level a couple of times and establish a resistance level. So what we might do is now draw a new line here and say, all right, fine. Let's take that line right there, not 25.25. And let's see if we, and Kelly says, try to move my stops above break even as soon as possible. So it's starting to roll back down a little bit, but there's that possibility it could increase. So rather than flip to the bearish side, because I don't see necessarily volatility bleeding off completely here, although volatility is a mean reverting instrument, we could see a move higher. So what I'm going to do is I'm going to create a new trade. So I'm going to move these points. So let me zoom back out a little bit, just kind of define what this trade will potentially look like. Let's come back here and go auto. There we go. And just as I say that, you see what it's doing. It's moving to the downside. So we're going to zoom in a little bit. So I'm going to take this and activate it. We're going to put this up here. This is going to be my entry price. And my crude oil contract just got sold. So we'll come back and we'll take a look at crude oil in just a second. We'll see what happens. So we're going to right click. We're going to activate this one. We're going to move this up to our stop. We're going to leave our target the same. So looks like volatility is bleeding off. So maybe there has been news, perhaps to cause volatility to bleed off. Before we set this trade up, I just want to check something. And as you're watching this, I'm going to /MCL here. We're going to pop over to our crude oil contract. And sure enough, we got stopped out on that pullback. Crude oil is falling. So now what that makes me think about is why. Why is crude oil falling? /ES. Let's take a look at what's going on in the S&P 500. So the ES is moving up just a little bit here. That would suggest that maybe there's some kind of news out there that is creating that relationship, right? That we're seeing crude oil move. We're seeing the ES 500, the S&P 500 move a little bit higher. We're seeing volatility bleed off just a little bit. I don't know what the news is. And I don't know necessarily, what the best source is. I just know what's going on in the futures contracts here as an indication of what's happening overall. So crude oil is coming down /CL. Could be PMI data for sure. I don't know that that's going to move crude oil much, but MCL, I'm wondering likely if that is something that is geopolitically derived. Could be PMI, but maybe not. So at the moment, well, that's okay. We perhaps made, if we go back to the monitor tab on that MCL trade, at least we got out with a small loss. And that's the design of the trade, is to help us to get out of a trade with a small loss. Now we got kicked out of the VX trade, the VIX trade with a little bit larger loss. But again, that's okay because it didn't turn into a much larger loss because we moved that stop to where it would have gotten us out with a smaller loss than what we initially had in the trade, which is okay, right? That is the nature of futures trading in a dynamic environment. So let's do this. The other one that I was looking at, let's go back to our charts. The other one that I was looking at here this morning was the 1 ounce gold contract. So let's take a look at /1 OZ, the 1 ounce gold contract. And this is the setup that I was looking for. So we'll look at this chart. This is the longer term chart, and looking for a little bit of a bounce and confirmation of a bounce over this longer term trend line. So we've seen gold. This is the 1 ounce contract. This is the this is at least the smallest that I know of increment in terms of the gold contract. This is 1 ounce. Tick size is 0.25. Tick value is 25 cents. Point value is 1. So we take that 1 times the price, and that gives us our notional value, which is the price of 1 ounce of gold. So what I was looking at here is this, looking for that confirmation of a bounce off of this diagonal trend line. We've gotten that now, and so we could look at this as a longer term trend. It's got very strong trend strength according to the ADX. So it's got a breakout of kind of this horizontal resistance area right here. So we may look at going long in this contract here for some upward movement. So I'm going to kind of zoom back out, or actually just going to pop over here to the right-hand side and see where maybe there is a target that we could look for to maybe take this trade off if this was going to potentially be a bounce. So we might look for a target maybe up here around this high, around the 5,000 mark, maybe up here around this high at about the 46.84. Or we could use this as kind of an entry into that longer term trade. We've got this RSI that's turning up off of the bottom. Not a guarantee, that it's going to continue to move higher. But we're going to use the concordance of this bounce along with what we're seeing in the shorter term chart to maybe take this as a longer term trend trade. I'm going to use this level right here as our stop in this trade. So I'm going to grab my labels. We'll make that our stop. We're going to make this our entry into the trade with no target at this particular point. So it's starting to pull back a little bit. As long as it stays above that level, I'm going to right click and I'm going to buy custom with stop. So we're going to create this trade as a longer term trend trade in this particular case. So we're going to look at getting in at a limit of 43.9725 or less. We're currently trading at 43.89. So that's going to be my limit price. And then my stop in this case is going to be 43.52. We're going to make that stop 43.52. And we're going to make it 43.52. We'll make it 43.52.50. We'll just make it a little bit different there. We'll make that good till canceled. We're going to click on confirm and send. Our initial margin in this trade is $340. So a small notion or smaller notional value than the big contract, smaller initial margin in the trade. I'm going to put this in my futures group and we'll look and see if we can get into this trade. So now we are long 1 ounce gold, trading that upward movement. If this becomes a bull flag and we've got to stop here, if this confirms this level of support, then it will move that stop up to that break-even point or that initial entry point into the trade. Now, I want to address the question that has come up a couple of times. And the question that's come up a couple of times, and I want to pop back over here to my single grid for this discussion. This is the S&P 500. I'm going to turn off implied volatility here. So this is the S&P 500, the SPX index. So the question is, how does the index influence the futures market, right? So what I want to do is I want to first establish how individual stocks influence the SPX. So the SPX is a basket, if you will, of roughly 500 stocks. Collectively, their price, weighted based on market capitalization, make up this price of the index. So when one of those components moves, when one of those individual components moves, that changes this index value. So there's an arbitrage relationship. That arbitrage relationship is that if an institution or a large retail trader sees that one particular instrument or others or many instruments in a group are moving, they could sell the ones that are going down and buy the ones that are going up, or they could buy the ones that are going up and sell the ones that are going down, or they could trade two different markets. Now, you can't buy and sell the SPX because all this is an accounting of those prices. This is an index. So they could use an instrument like a basket instrument like an ETF. Now, I'm not talking about ETFs as a tradable other than to say that they exist. I'm not talking about them specifically or naming any of them. If you're going to trade ETFs, make sure that you understand the characteristics, risks, charges, and expenses of an exchange traded fund by reading the prospectus before you trade any of those products. But that's one possibility in terms of arbitrage. But that becomes a little bit difficult too. So what institutional traders may do is if they notice movement in the S&P or in the components of the S&P 500, they may trade the futures contract relative to the SPX. So what I'm going to do now is I'm going to take off of here the 50-period moving average, and we're going to put a comparison line. Comparison. And I'm going to change this comparison line to /ESM26, which is the most current contract. And I'm going to click on OK and apply and OK. Now you see that there's a little bit of difference between the current futures contract and the S&P 500 index. So let's zoom in to a shorter time frame here. Let's go to a 5-day, 5-minute time frame. So you notice that at the open here, there was a little bit of a difference. So this was at yesterday's close. Overnight, the futures contracts traded up a little bit, and then we saw this gap down. So we saw that gap down. Futures were trading a little bit less than the value of the contract. Or excuse me, the futures contract was trading a little bit less than the index. Now the index is trading just about in line with the futures contract. The futures contract includes, the price of that futures contract includes carry costs, which are interest rates minus dividends. So if you want to think about this, the futures price, whatever this price of this futures contract, 6608.25, that's over here on the left-hand side. Whatever that price is equals the spot price of the SPX plus interest minus dividends. Okay, that gets us to the futures price. Because remember, futures is a forward-looking instrument. When that futures contract gets to expiration, those carry costs are assumed to be gone. But in the meantime, there's an arbitrage relationship. So if the SPX begins to move, meaning individual components of the SPX begins to move, and the SPX is trading above the futures contract, guess what happens? An institutional trader could sell the components of the SPX and buy the futures contract to bring those back in line with one another. So that's how it's that arbitrage between those two products. It's not a tracking error. It is an arbitrage relationship. Okay? It is an arbitrage relationship because the institutional traders can and do buy and sell components of the SPX or the whole basket of the SPX and buy and sell the futures contracts. That's why those futures contracts to a large degree exist, so that they can arbitrage that movement and take advantage of that cash and carry, that carry cost, right? So if the futures, think about this, cash and carry arbitrage, the futures is overpriced, the futures is greater than the spot plus the carry, trader borrows money to buy the shares of the stock and sells the futures contract. And at expiration, they deliver the stock to fulfill on the contract, paying off the loan, keeping the excess as a free profit, right? Or if the futures contract is underpriced relative to the SPX, they would potentially short those stocks, invest the proceeds in a risk-free interest-bearing instrument, buy the futures contract. At expiration, they use the delivered stock from the contract to close their short position, and they profit from the difference. It is confusing, but it is a relationship. Just think about it this way. It's an arbitrage. It is buying and selling one thing versus another to keep prices in line. They don't get out of line for a long period of time because there is that ability for institutional traders to buy and sell either side to keep things back in line. So this fair value versus the index price relationship is what keeps them in line, and it's also what moves the futures contract relative to the SPX. We'll go a little bit deeper into it. It's a long explanation. We could spend an entire class on that, but let's take a look at what we've done really quickly. There's our 1 ounce contract, which is coming back. There's our micro crude that is now going back up or going back down a little bit, and the VIX is coming off again. Now the VIX is down around 24. You want to learn more about futures? Pop on over here to schwab.com/futures. Great place to learn about it. If you want to learn a little bit more about what we've done in this webcast, come over here to the Trader Talks webcast page, click on subscribe, and you can see all of the previous webcasts that we've taught, all of the recorded webcasts that we've done. And this is a great learning environment. Just click on the subscribe. Valencia says, is it fair to say that this happens at open of market? Yes, that's where it primarily happens, but it can happen at any time throughout the day. So some great resources for you guys. Make sure you fill out that feedback survey so that you have the ability to let us know what we have done and whether that's working for you. Please Let us know what you think. We read every single one of those comments. My thanks to Connie Hill for helping out. My thanks to our great production staff. And my thanks, of course, to our phenomenal reviewers, Nikki and Mindy. Everybody have a great day today. I will be back tomorrow teaching trading index options tomorrow afternoon. We'll see you then. Take care, everybody. Bye-bye.